So by now you will be seeing my screen. I hope you can see my screen now. Just confirm that you can see my screen. At least I need one or two persons. You just type that they can see my screen. All right, thank you so much. I have seen your response that you can see my screen. So let us commence. As at 10:18, we have 49 people on the call. So good morning once again. Like I have said, today we are going to be talking about insurance regulation and consumer protection. Before now, you already know what insurance is. And without much ado, it plays a vital role in economic development because it helps to provide financial protection against risk. I hope you know that before now. However, in this our country, or let me say anywhere you find yourself, there is need for regulation. And this regulation will help us to give us the rules guiding insurance operation, as well as protect the consumer of insurance. This will help us to price insurance company, protect policyholders, as well as promote confidence in the insurance industry. So if there is no regulation, insurance company will have instability or will experience instability because they will just be doing anyhow, while policyholders will be unsafe and they will not have confidence in the insurance industry. So when we now say insurance regulation, it refers to the set of laws. So when you hear regulate, regulation, these are laws, these are rules, guidelines, as well as supervisory practices that are established by the government authority to control and monitor insurance company. Let me repeat myself. When you hear regulation, what should come to your mind is set of laws, rules, guidelines, as well as all those supervisory practices that are established by government authorities to control and monitor the operations of insurance company. So this insurance regulation will then help us to operate the insurance company according to the rules and guidelines. And even the insurance company will be supervised. So it's not that nobody is watching them, somebody is looking at them. And as such, they will operate fairly, they will remain financially sound, as well as they will be able to fulfill their obligations to policyholder. But assuming there is no rules, there is no set of guidelines, there is no supervisory practice, so nobody is controlling them, nobody is monitoring them, it then implies that they may not operate fairly, they may just be doing anyhow since nobody is controlling them. So that will lead us to the objectives of insurance regulation. Objective of, like we have explained in the definition, the main objective is to protect policyholders as well as the general public. That's the main objective. It also allow us to ensure that this insurance company have what we call financial stability as well as solvency. So when you say solvency, ability to do what? Ability to withstand the business fluctuations that may occur, just because in business there are a lot of things that happen. So a company that enjoys solvency is a company that has the ability to withstand anything that happens to its capital over time. Another thing is it helps to promote fairness, transparency, and what? Ethical practices. So all the insurance companies, just because they know that they are being regulated, they will operate fairly. So regulation will allow them to also be transparent, and they will do things ethically. They will not go against ethical principles, and so on and so forth. More importantly, before I proceed, I will also let you know that this will help to prevent fraud as well as any other sharp practices that can occur. It also helps to promote orderly growth and the development of the insurance industry. Yes, somebody said they want me to go back a little bit so that they can also follow. So like I have said before now, we were trying to define what is the meaning of insurance. Before now, we already know that. But insurance regulation is why we are here. So when we now say what is insurance regulation, just like I have said earlier, just as a form of emphasis, they are regulations that refers to a set of laws, rules, or guidelines, as well as supervisory practices established by government authorities to control, monitor the operation of insurance company so as to protect the policyholder, as well as ensure that this insurance company, who are the insurers, they operate fairly, they they remain financially sound, and they are able to fulfill their obligations. Just like I have explained too, from this definition, you understand that majorly the objective is to promote financial stability, fairness, transparency, protect policyholders, prevent fraud, and ensure that the insurance industry also grows. Now, let us look at the forms of insurance regulations that we have. I hope we are following me. I hope you are following me. So, insurance regulations can be in various forms. The first regulation is what we call licensing and registration. An insurance company must initially or first of all be licensed to operate. They cannot just come into the insurance industry to operate. No. Government will first of all provide or give them license to operate. So without license, they will not be able to operate. So that's the first regulation, licensing and what? And registration. The next one, which is what we call solvency regulation. If you recall, I said ability to maintain the business for a long period of time is what we know as solvency. So when you now say solvency regulation, that means they are required to have what we call certain capital in form of reserve. When I say reserve, all insurance companies must have a reserve capital so that anything that happens, they will be able to maintain solvency over time, and they will be able to meet claims when their policyholders made claim. So this reserve is what is also monitored. We call it solvency margin. So these solvency margins are monitored by the regulatory bodies or authorities regularly. So any insurance company that does not have a particular amount of capital that is required at a particular point in time may be delicensed or deregistered. So, for example, they may say every insurance company must have maybe 100 billion naira as a reserve. So any insurance company that does not have 100 billion naira as a reserve may or might not be given license to further operate. That means they cannot cope. They don't have solvency. So that's another form of regulation. Why am I saying this? This will allow them to be buoyant capitally, or they will be able to have the adequate capital to run the insurance business. Another thing is that they usually regulate the rates. Insurance company, they usually charge what we call premium. So because they charge premium, the regulation will also control the minimum premium or approve insurance premium given a particular type of insurance policy that you want to engage in. So so that it is not that they will be exploiting consumers. No, almost all insurance companies will be following the approved minimum rates regulated by their authority or the government authority, as the case may be. So I have mentioned licensing and registration as one of the regulation or regulatory practice. I've also mentioned solvency regulation, and I've explained that. While I also explained that this rate, the rate at which they charge their premium for all the policies they are selling, is also controlled or approved. This will help to prevent unfair pricing as well as exploitation. More importantly, we also have what we call market conduct regulation. Market conduct regulation. What does that mean? How they operate, how they deal with policyholders, how they deal with their sales practices, what is expected for them to do when they want to do claim handling, how do they advertise their products, how do they deal with disclosure of information. All these ones are what we call market conduct regulations. It then implies that the insurance companies, they are already in a particular type of market, and this market, they buy and sell insurance. They have to be able to conduct themselves in that kind of market. So I have mentioned 4 areas by which they are being regulated. One of which is number 1, licensing and registration, which I have explained earlier. Number 2 is what? Is what we call solvency regulation. Number 3 is what we call rates and products regulation. And number 4 is what we call market conduct regulation. So all this regulation that we have mentioned, in Nigeria as a case study, the insurance regulation is carried out by NICON. And what's the full meaning of NICON? National Insurance Commission. National Insurance Commission is the government authority that is charged with the following function: to license and supervise insurance company, to ensure that they comply or to ensure adequate compliance, legislative arm of the government that will formulate insurance laws. However, they are to ensure this insurance company complies with what? Insurance laws. They are also meant to protect policyholders' interests, that's consumer protection, which is also one of their functions, as well as they will promote insurance awareness and what? And development. So when I was saying that these insurance companies are regulated by law, in Nigeria now, we have the Insurance Act of 2003 and we have the NICON Act. The NICON Act is the act that established NICON, National Insurance Commission. So these 2 acts are relevant apart from other laws that can also be used to ensure that the insurance company follow rules, regulations, guidelines, as well as supervisory practices. So let us now look at consumer protection. Who are the consumers of insurance? The consumers are the what? Are the insured. They are they are known as insurance policy holders. So when we say consumer protection, we are trying to refer to a measure that is put in place or a policy that is put in place designed to safeguard the rights and interests of insurance policyholders so that they will not be treated unfairly by the insurers. Who are the insurers? The insurance company. More importantly, it ensures that consumers receive the value for their money and they are treated fairly throughout the contract, throughout the what? Insurance policy that they engage in. These consumers have the following rights. They have the right to be given adequate information about what they want to do, the insurance product that they want to do. They also have the right to be treated fairly, as well as transparent pricing. They should not be hidden charges. They should be informed about what they are expected to pay, at what rate, and so on and so forth. Then whenever they want to claim, because sometimes when they engage in insurance and they want to go in and take a claim after something has happened, just because they are covered by insurance, they need to be treated fairly and promptly. Another insurance consumers' right is that they have right to what we call privacy and confidentiality. They are not meant to disclose, or insurance companies are not meant to disclose their personal information to the general public. And they have the right to redress and complain. So if they feel like they are not treated well, they can always complain to Nikon. They can always complain to what? To Nikon. So all this will allow for them to be protected. So what I have said, they have the right to do what? They have the right to be given information, and this information will allow them to have what? Broad understanding of the terms and conditions of the insurance policy at hand, and so on and so forth. They also have the right to claim settlement. What are the procedure if they want to go and claim a particular thing, and so on and so forth. They also have the right to be aware. So they need to be educated. As a consumer, you need to also be educated about their rights and obligation. So if you are entering into an insurance company, then the insurance company has the right to also give you adequate information, as well as education about what you want to do. Then they can also complain. But in Nigeria specifically, there are challenges that are going to be an hindrance into insurance regulation and consumer protection. What are those challenges? Low level of awareness, weak enforcement. Weak enforcement of regulation is a challenge. So when there are laws and nobody is implementing it, or nobody is enforcing it, then these are issues. Delay in claim settlements. In fact, some insurance companies in the past have also engaged in unethical practice and fraudulent activities. And even consumers themselves don't know their rights. And if they don't know their rights, they will not know how to claim their rights. So all these are challenges associated with insurance regulation and consumer protection. But even with this challenge, this insurance regulation and consumer protection is important, so that the public can have confidence in the insurance industry, so that policyholders, when they know that and they are protected, they will be free from exploitation. All the insurance companies too have financial stability, since they are following guidelines. They will be stable, and normally there will be fairness, there will be transparency, and finally there will be what? There will be growth. So summarily, insurance regulation and consumer protection are so much essential for a stable and trustworthy insurance industry. So through effective regulation and strong consumer protection mechanisms, policyholders' interests are safeguarded and insurers remain solvent, as well as the insurance sector contribute meaningfully to economic growth and stability of the society or the country. So that is that about the topic. Before I proceed, we have talked about insurance regulation and its objectives. We have also talked about the various forms of insurance regulation. We have also mentioned the regulatory body, which is known as NICOM, National Insurance Commission. We have talked about what is the meaning of consumer protection, and we have discussed the challenges. So in going through this discussion, you can also use this review question as guidelines. So in the chat, just drop what you think insurance regulation is, If it is not insurance regulation that you want to drop, you can also drop one of its objectives or two of its objectives to show that you are following. If at all you cannot also drop that, you can also drop the forms that you know based on our discussion, and you can tell me the full meaning of Nikon and what is the function of Nikon, or what do you think consumer protection is, and you can also tell us maybe a challenge that is affecting insurance regulation based on our discussion. So in the next 1 or 2 minutes, I will expect you to do that on the chat box before we then proceed to the final topic for this bed 107 class. So I will be monitoring your chat to show that you are really following me. So this review question, after a few minutes now, I will not display it again, and then we will then move to the next topic. Yes, thank you so much. Now I realize that you are following based on what you are dropping. I want us to know that most of these things are digital digital evidence that you are part of this class, and as such, if you think I am not following, for example, let me read what Karim Messi just dropped. That okay, insurance regulation refers to the set of laws, rules, guidelines, supervisory practice established by government authorities to control and monitor the operation of insurance company. So that shows that Karim Messi is giving us definition of insurance regulation. Let me also let you know that Bolaji Olaniyi has said Nikon means National Insurance Commission. These are people telling us that they are following us. So let us go to the next topic. And the next topic, which is the final topic, is what we call risk management and insurance planning. Risk management and insurance planning. Risk. Before now, we have talked about insurable risk and non-insurable risk in our physical class when we started this course. But because risk is part of every human endeavor, whether in business, whether as an individual, whether you are even a government, everybody face uncertainty, and this uncertainty can lead to financial loss. But insurance is there to also protect you against this uncertainty. However, let us now look at the link between risk management and insurance planning. Before I proceed, what is risk? That, just like I have explained earlier, risk refers to the possibility of losing something, damage, injury, as well as unfavorable outcome or uncertain arising from where? On an uncertain event. So when you say this thing is risky, that means you can either there's possibility of losing there's possibility of damage, there's possibility of injury, or there is possibility of what? Unfavorable outcome. That is when you say this thing is risky. But risk can be pure, speculative, personal, property, business, or liability. So when we say risk refers to possibility of loss, you can lose something that is pure based on based on fire or accident. These are pure risk. So it may or may not happen, but they are pure risk because it involves the possibility of loss or no loss at all. So if fire does not affect your business, then there is no loss. But if fire affects your business, then definitely there is loss. If there's an accident, there is definitely a loss. If there's no accident, there is no loss. But there are some speculative risk. When that one you say, possibly you can, if you do it, you will gain. If you do it, you will not lose. This type of risk that we said, they are what we call speculative risk. If you do investment, it's either you make profit or you make loss. That is speculative risk. Personal risk, when we have risk that has to do with if you do not what? If you do not have job, that one is personal. It will affect you as an individual. Probably you are sick, it will also affect you as an individual. All these ones are what? Personal risk. We also have what we call property risk, liability risk, and business risk. Just like the name implies, personal risk are risks that are personal. Business risks are risks that affect your business operation. Then liability risk, because these are risks that are associated with legal responsibility. So by law, you are expected to do it, and if you do not do it, you will pay. These are legal risk. So all these are forms or types of risk. We are talking about risk management anyway. So what is now risk management? If we have explained what risk is and the various type of risk that we have. So risk management is the process of identifying, and controlling risk so that we can minimize their adverse effects on individuals as well as on organizations. I want to say that I am appreciating what you are dropping to the chat. It shows that you are following. Now, more importantly, when we now say risk management, management tells us that is the process of what? Identifying. You have to first of all identify the risk. You have to let us analyze the risk. You have to do what? You have to control the risk. Identify, analyze, and control the risk. Why are you controlling the risk? It's not that you are controlling the risk so that there will not be risk at all. No, you are controlling the risk because you want to minimize the adverse effects, because risk itself, just like we have defined initially, is loss or damage as a result of uncertainty. So you only need to minimize the effects. But before you do that, you will have to do what? You have to identify, analyze, and control this risk. And that is what we refer to as what? Risk management. How is it related to insurance? Without wasting much of our time, we have talked about risk management, how it helps to boost financial, how it helps to boost what? Financial stability, how it helps to stabilize income, minimize loss, ensure continuity, and make decision, improve your decision making even under uncertainty. And we have let us know that first of all, in risk management, you have to identify the risk. You have to also control it and implement decisions around it so that you can monitor and review. How is it related to, that's what we want to talk about. How is it related to insurance? Insurance planning is just a systematic process of identifying insurable risk. I hope at the beginning of this class, when we are talking about insurable and non-insurable risk, insurance planning is now the process of identifying insurable risk, selecting the appropriate insurance policy to provide adequate financial protection against potential losses. So in risk management, you need what we call insurance planning. Just because in risk management, you said you have to identify, analyze, and do what? And control risk. In identifying risk, you have to do what we call insurance planning so that you can systematically identify the insurable risk. Which risk are insurable? If you know this risk, because we have various type of risk, this kind of risks that are insurable, let me now select the appropriate insurance policy that will provide adequate financial protection against any potential loss, and that is insurance planning. It is so much related to risk management at the identification stage. It helps to boost financial security. It helps to boost individual, family, business. It helps to ensure that you have compensation if there is any loss. It encourages you to save, invest, because when you know that your investment is safe, you want to put more money there, and it gives you peace of mind. In the last class, physically, we said we have life insurance or life assurance, we have health insurance, we have property insurance, motor insurance or vehicle insurance, liability insurance, we have all other forms of insurance. All these type of insurance, you can put them into your risk planning. When you know that these are what? These are insurance that are insurable. These are risks that are insurable. So the uninsurable risk may be a personal risk. And if you know that they are uninsurable, then you have to only find a way to do what? Avoid it or prevent it. But the ones that are insurable, and you know that if you go into them, they are either a pure risk, they are either a business risk, or they are what? They are speculative risk. Then you can use insurance planning to identify them, identify an appropriate insurance policy that will allow you to protect against any financial loss. Then you go into it. So that is why I'm saying that insurance is a major tool of risk management. It helps you to cover insurable risk. It also helps you to transfer the insurable risk to the insurers, thereby a financial burden on either you as an organization or as an. But risk management, or let me say using insurance as a risk management tool, is only on insurable risk. Not all risks are insurable, so it is not all risks that you can insure. Insurance is not saying that it will not happen. No, it will only compensate you if it happens. That is another. To pay for it because they are covering you, so you have to be time. And in case there's a challenge in claim settlement, then you will feel like, why do you initially insure yourself? However, they need to understand whether you are really indemnified to be compensated. But even with all these limitations to insurance as a risk management tool, it is still important. If you don't want to be anxious, if you want your business to continue, if you want to grow, if you want to be stable, risk management and insurance planning are still very, very much important. So summarily, risk management and planning are essential strategies for dealing with uncertainty, as well as it protect potential loss. Through you can do what we call effective insurance planning. As an organization, you can what? Minimize your and ensure long-term stability. That means you have solvency. So that is that about risk management and insurance planning. So without much ado, it implies that we are going to be rounding up the class. But even though we are going to be rounding up the class anytime soon, I will want us to also look at questions that we have. When I say review questions that we have, it implies that what are risks from what we have discussed? Drop the answer in the comment section. What are the type of risk based on what we have discussed that you know or that you can explain briefly? What are the process of risk management, or what is even risk management in itself? And what is insurance policy and why is it important? All these questions, provide answers to them in the comment section, while I also monitor for some time to see whether you are actively following. So permit me to appreciate you for joining the class. However, we started this class with 49 or 50 people on board, and currently we have 32, or let me say 34 on board.